Hey, Dave. So Safehold's the only public company focused on ground leases, which means we own the land under commercial buildings in the top cities around the country. As you know, ground leases are a great asset class, mostly owned by wealthy families, churches, universities. And until Safehold came along, it was really an asset class that most people were effectively shut out of participating in. Sure, so we have been in the finance and net lease businesses really since the early 1990s. But we saw this opportunity in ground leases and really jumped on it in 2017. Created a new public company called Safehold. And we've really seen the transformation of the corporate real estate market through our net lease lens. And that had created a multi-trillion-dollar industry by separately capitalizing these operating businesses from the fixed assets they own, like warehouses, cell towers, casinos. So the market had gotten very efficient around, hey, if you're running a business, you shouldn't capitalize that the same way as the underlying assets, the fixed assets, like the cell towers, the casinos, the warehouses. So we saw the same opportunity to bring that efficiency to the overall commercial real estate market. And to do that, we needed to modernize the ground lease. We needed to make it something that could work in lots of transactions. And so what REITs allowed us to do was give us a vehicle to allow everyone to invest in ground leases, not just wealthy families and churches and universities, and to do so in a very tax-advantaged way. So REITs were kind of the perfect structure for trying to really revolutionize the way the commercial real estate industry thinks about land and buildings. Yeah, so the bull case is twofold. One, it's we think this is an incredible asset class, again, owned by lots of the wealthiest people in the world. And the reason that has taken place is if you think about long-term bonds today, the yield to maturities are in sort of the 5.5% range. Ground leases tend to generate about 100 basis points higher yield to maturity. So you're starting with what I will call alpha, a higher return for similar risk. But it's better than that because bonds typically have no protection against inflation. Ground leases typically have CPI protection, i.e. if inflation is hot, they actually return more. With bonds, you get back par at the end. With ground leases, you get back whatever's on top of your land in addition to your land. And so that means you typically get back many multiples of par. That's not always the case, but over long periods of history, that's what we've seen. So you're creating a lot of value in a very tax efficient way over long periods of time, compounding that wealth. And so from one standpoint, we just think it's a great asset class. And it's one that, candidly, we were never able to invest in institutionally, and we wanted to change that. And I think we've done that. The other is just the fact that real estate is such a big part of the capital markets in our country. We think this is an enormous opportunity. We think that we're at the beginning of a very long growth cycle in building Safehold to the scale that we think could be tens, if not a much larger billions of dollars. And so there's a growth curve that we're just beginning on as a young company, but as we learn more and more about what our customers need and expand our capabilities, we think there's an enormous opportunity set ahead of us. There's about $7 trillion of commercial real estate in the top 30 to 40 cities in this country. We think a lot of that is candidates for the new modern ground lease that Safehold provides. So, we're about a $7 billion company today in terms of assets. We think there's a lot of opportunity ahead of us. Well, ground leases are typically very long-term instruments, often 99 years. So they act like long-term bonds in terms of their cash flow and valuation. And so when rates go up, it's not so great to own a long-term bond. Now, we would argue a couple things that we typically use, long-term financing. So when rates go up, our NPV of our assets goes down, but the liability side also gets reduced. So we think we're a little bit hedged that way. We also have the inflation protection, which bonds typically don't. So if rates are running high, it typically means inflation's running high, which means pretty much every 10 years or so, we pick up part of that inflation in our rents that our building owners pay to us. So there's some good counterbalancing components to ground leases that bonds don't typically have. And then, of course, we get what is sitting on top of the land at the end of the ground lease, which, you know, we track all the time to show how much value is building up for our shareholders. It's almost $9 billion today, actually a little bit over $9 billion. Doesn't show up on our balance sheet, but we are the contractual owners of whatever sits on top at the end of our leases. And we think of that as another asset class inside of our portfolio that right now I think shareholders don't give us credit for. And I think in terms of, you know, counteracting some of the inflation and high interest rates, we think that's a big part of the story. Well, we're the only public company doing ground leases, so we're the only way you can participate in this asset class that through centuries has built some of the great fortunes in the world. We've got a very strong balance sheet. We're rated by S&P, Moody's, and Fitch, A-, A3, A-, so high grade credit, diversified portfolio. As I mentioned, about $7 billion spread across all the major food groups, hospitality, multifamily, office. And so we're a disruptor. We're changing this industry. We've seen it work in the net lease side and the corporate real estate side. It created a multi-trillion-dollar business opportunity over there. But not everybody understands the disruptors right out of the box. So we think we're not fully understood. We think our share price doesn't reflect the value we're creating. That creates an opportunity.